Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the upcoming US jobs report taking place on Friday, the 5th of April. And certainly everyone wants to know about the implications in terms of monetary policy with just 2 months out until that June meeting that markets are currently speculating will mark the first rate cut from the Federal Reserve within this cycle. There's question marks as to whether that will be the case, though, because we have, of course, shifted from earlier in the year where markets expected 7 rate cuts this year, now expecting 3 rate cuts kicking off in June. But we have been hearing from some Fed members that they're willing to be relatively patient, and there's grounds for that. Part of it is the fact that the US jobs market continues to remain relatively strong, and the inflation picture remains relatively stubborn. Let's get into some of the numbers, though. I just wanted to show you first and foremost what markets are expecting. This is according to Trading Economics. You can see a prediction of 200K on the headline non-farm payrolls figure. Bearing in mind, this comes off the back of 4 consecutive payrolls beats. So are we going to once again find ourselves above that 200K mark? Unemployment expected to remain at 3.9%. The average hourly earnings, most notably on the month-on-month basis, expected to come in at 0.3% after a welcome 0.1% last time around. Nonetheless, that increase on the monthly metric is expected to still lead to a decline in the year-on-year figure, down to 4.1%. Participation rate expected to remain as is. And there's a few other parts down there, but we'll get into some of the major pieces right now. So first and foremost, here's a sort of overview of exactly what the likes of Jay Powell are looking at from the jobs perspective. I wouldn't necessarily say there's huge concerns there. We're seeing weakness in terms of certain things like the JOLTS job openings figures. But by and large, if you look at where we were pre-pandemic and where we are now, we're just back to where we were. Similar kind of thing in terms of quits, participation rate. A lot of it has really normalized. And that's something that is worth bearing in mind, because a lot of the time when you get late on into a certain economic cycle, you might see, for example, payrolls coming in relatively weak, but that might just mean that we've seen unemployment rate at such low levels that we don't necessarily see that same massive catch up, and so there's some normalization. So we are seeing some reversals in terms of some of the JOLTS numbers, but I wouldn't necessarily say it's too much to be concerned about at the moment. Here's the breakdown from a sectoral basis for US payrolls. Notably, last time around, we saw quite a strong rebound in terms of the leisure and hospitality numbers. And I think that's an interesting one, because if you look at the breakdown in terms of the part-time versus full-time employment gains, what we have seen over recent months is that the upside we've seen in terms of payrolls and the better than expected payrolls numbers have arguably come via a double counting method, where we see people essentially taking on part-time roles to deal with the elevated inflation rate and the cost of living nowadays. And that isn't necessarily the same as seeing a massive surge in full-time roles being taken on. And so you would think that leisure and hospitality, probably the kind of area where you might see people pick up more than one job. So it is notable that that's where we saw particular strength last time around. So there's a caveat to this. Look, we could see another month of strong payrolls, but if we see part-time jobs rising and full-time jobs falling in terms of the job creation, then, there's a caveat that the Federal Reserve are likely to be keeping an eye out on. In terms of the relationship between the ADP and the non-farm payrolls figure, this is worth bearing in mind. Of course, everyone really looks at these two metrics and says, ADP is relatively useless when it comes to predicting the headline payrolls figures. But nonetheless, we've actually been relatively consistent of recent months. We haven't seen the same numbers, but all we have seen is roughly 120 to 140 extra on the headline figure compared to the ADP figures. So you can see on the top section, the orange line is the headline non-farm payrolls figure. And we've been relatively consistent in terms of the trajectory. If you look at the distance between the two, there is some consistency there. And if you look back in, say, 2022, we're seeing, like, if you look at the bottom section of this chart, we're seeing wild swings in terms of whether one is over the other, and that doesn't necessarily point towards any help from the ADP number. So it's worthwhile looking out at that ADP number, but if recent trends are anything to go by, you can probably add 130 onto it if you want to come to what we might see when it comes to the actual headline non-farm payrolls figure. Looking at unemployment, we have seen it remain relatively steady below that 4% mark. We have ticked up a little bit higher recently, but I wouldn't necessarily say it's anything to concern us, and certainly not something that the Federal Reserve are going to look at and think, well, we really desperately need to make a move right now. Certainly the relationship between the Conference Board jobs hard to find divided by plentiful ratio really, previously did point towards a possible tightening within the market that might see some upside for unemployment, but that's actually broken down over recent months. And so that, again, doesn't necessarily point towards an uptick in terms of unemployment in the coming months. And then another chart I've got here, which is the relationship between the unemployment rate, which is the blue line, which I've inverted, of course. It's not been rising. It, of course, fell and then has been largely flatlining. And then the job openings figure and the US core CPI. What's notable here, I would say, is that the Federal Reserve has done a relatively good job when it comes to cooling the economy to drive down inflation, which we can see with that green line, but not necessarily seeing a massive spike in terms of unemployment. That's arguably exactly what they would have wanted. They don't want to damage the economy, but they need to cool it to the extent that they can drive down inflation. In terms of the payrolls figures, you can see the declines seen over recent months following that incredible chop around the COVID pandemic. But we've essentially normalized now, and we're back into that band seen pre-pandemic, 2014, 15, 16, 17, 18. It all looks relatively similar. We're rotating between these same thresholds, and that's exactly where we are now. We're back in the sort of mid 200s. So even if we saw a little bit of downside, I wouldn't necessarily say that that's something the Federal Reserve are going to say, wow, this is a big catastrophe. We're some way away from that. Sub 100K, fair enough, it's a problem. But I wouldn't say it is at the moment. And so unemployment isn't a problem at the moment. I think payrolls isn't necessarily that much of a problem. But of course, you can look at it and say it's predominantly being driven by part-time jobs over recent months. But average hourly earnings, that's another area we need to be looking at, because of course wages feed into inflation expectations. We need to see that decline. So like I said, the expectation is that we will see this figure decline, but the month-on-month reading is expected to come in higher at 0.3%. Of course, if you're looking for a figure that's going to start pointing towards us moving back down to 2%, then you'd want something more like 0.2% or below on a monthly basis. So keep an eye out for that in particular. Here's the relationship on the top end between the average hourly earnings and the core CPI, of course, very closely related. So any further downside in terms of the wage figures will give us greater confidence that we'll also see further downside in terms of the inflation metrics going forward. I've taken the sort of 3-month annualized wage growth figure at the bottom here, just because, you can see a single month and it can kind of skew things. So I just wanted to take it 3 month by 3 month and just show you the sort of trajectory, the sort of what I would put as normalized or normal levels are within the band. You can see here this gray shaded band, and you can see on the left hand side of the bottom section that that's essentially where we used to be pre-pandemic. We're getting towards that level. We did see a recent pop, but trying to come back down towards that area. So a little bit elevated. The Federal Reserve will see this and think, maybe there's a little bit more they can do on the inflation front, the wage front, and the like. And so this points towards a little bit more patience being required from the Federal Reserve. Well, both sections of this, because core CPI is also above target. So to tie all of that up, we talk about unemployment rate that I think they're not necessarily going to be too concerned about at the moment. The payrolls look relatively healthy, even if we saw a bit of a decline. I don't think it's going to be a drastic issue that the Federal Reserve are suddenly going to have to cut interest rates to alleviate. And then the average hourly earnings, we have seen it relatively elevated over recent years. It's coming down, but still remains above target, 4.3%. They need to get it, below that 3%, and that could take a little bit of time. So the idea that we're going to suddenly see the Federal Reserve cut interest rates, for me, is a little bit doubtful, quite frankly. So in terms of how this could tally up for markets, first and foremost, I wanted to show you what's happening on the US indices front. This is the Dow Jones Industrial Average. It's playing out across the NASDAQ and the S&P as well. And that is that we're seeing this sharp pullback to kick off the week. And it's taking us back down in towards this ascending trend line. So the wider trend, as highlighted on the daily time frame, remains in play unless we break the 38457 swing low that we have here. Until that happens, someone might say, well, look, we've got a double top formation. I wouldn't necessarily think that's a problem. Yes, that points towards near-term downside, but essentially this to me looks like a retracement within a very clear uptrend. And unless we break the 38457 mark, there's a good chance that this will soon enough find stability and start to gain ground once again. The caveat here is, like I said, this jobs report, I don't necessarily think will give us much grounds for thinking we're suddenly going to see the Federal Reserve cut interest rates in June. So, look, if we saw a weak jobs report, and if we in particular saw weak average hourly earnings, that could provide some upside for this market. But if we saw strength in terms of the jobs report, and in particular strength in terms of the average hourly earnings data, could that drive down this market in terms of a sort of good news is bad news kind of thing? I think it's questionable, quite frankly. We've grown quite accustomed to the fact that the jobs numbers have come in relatively strong of late. So I don't necessarily think it's going to be that much of a mover on that front. I do think the average hourly earnings are ultimately the thing that's got the greatest potential of moving this market. Because even if we saw a downside move in terms of the payrolls, below what's expected, markets can just sort of look back at recent months and say, well, there's some normalization there because we've beat on 4 consecutive months. So certainly the average hourly earnings should really drive sentiment for this one. And if you're looking for an area where we potentially see the bulls come back into play, it's very clear here. We've got this ascending trend line. We've got that 61.8 Fibonacci at 390.10. And the 76.4 at 38799. So this key area of support down below, well worth watching. And only with a break below this 38457 would I start to think we're going to see a wider pullback coming into play for the Dow Jones Industrial Average. In terms of the US dollar, we're starting to weaken somewhat. It's very interesting that we're seeing weakness in the face of downside for equity markets. So the role of the US dollar as a sort of safe haven really coming into question here. Nonetheless, the question marks around the timing and the pace of Federal Reserve rate cuts has lifted the US dollar recently. And that points in my mind towards the potential for further upside. In particular, if we see sort of, as is expected, a relatively strong economic picture and a relatively strong average hourly earnings figure, that would all point towards the potential for further US dollar upside. If we're looking at sort of, what would I need to see to start thinking that this market's going to roll over once again? The most notable level is 104.012, and therefore near-term downside, I think, has a good chance of being picked up once again. The caveat here is, of course, we've seen this sort of fake out with the breakthrough resistance and now pulling back. But until we break that 104 level, then there is a good chance that we see further upside if, as I suspect, the Federal Reserve have the potential to push back once again, because inflation remains a problem. The jobs market remains healthy. And if we see this jobs data coming out strong once again and the average hourly earnings coming out strong, it's a possibility that we do see the US dollar coming back into strength once again. And finally, I wanted to highlight gold. This has been a massive outperformer of late. It's one of my big plays for the year, and it has been playing out absolutely perfectly. The breakthrough 2075 came last month, massive pop there. And really, this is going to be a case of playing it on a sort of shorter time frame, sort of 1 hour, 4 hour basis. I have expectations of further gains, and therefore it's just a question of, look, we've seen the consolidation, the pop, the retracement, then the rally from there. We've seen the pullback here. the subsequent rally. Now we're weakening a little bit here. If we break your near-term swing low, then we're looking for that wider retracement to come into play. But until that happens, near-term pullbacks are likely to be bought into once again. And ultimately, whether we see the jobs data coming out strong or weak, the question mark here is, will we see the Federal Reserve cut rates in the coming months? If that becomes more likely because of this jobs data, then we're likely to see gold doing well. If it gets pushed back further, we could see a bit of weakness. But arguably, what we have seen over the course of the past month is the US dollar reacting well to the fact that we're seeing markets starting to reprice in favor of fewer rate cuts. But ultimately, people are just jumping the gun and front running it here in terms of gold, and really starting to see some significant strength coming into play. We're starting to see, we have seen record highs here for gold, and I don't think it will be the last of the strength for this market.